Every day your money sits in a savings account, it actually loses value. Inflation is a tax on those who don't invest. Building wealth isn't about being a genius. It's about having a simple plan. No stock picking, no timing the market, just a few ETFs. Here at DCAKings, I'm showing you the full blueprint to fight inflation and grow your wealth. In this video, we'll cover why not investing is quietly making you poorer, what ETFs actually are, why waiting for a crash is statistically a mistake, how to build a clear investment plan and a custom portfolio, and how to choose the right broker and execute your first buy. Master these 5 principles and you're already ahead of most investors. Let's get straight into it. This chart shows you exactly why you need to invest. On one side, we have the global economy expanding, represented by Vanguard Total World Stock ETF VT. This is an ETF anyone can buy. Historically, the global stock market has returned around 8% per year over the long term. On the other side, we have inflation of major global currencies. The US dollar loses around 3% of its purchasing power per year. Over decades, that 5% gap compounds massively. Over the last 30 years, the dollar lost 50% of its value, while the market gained 900% nominally. Even after inflation adjusted, that's still roughly 400%. If you aren't investing, you aren't standing still, you're moving backwards. This is where ETFs, exchange-traded funds, come in. An ETF is a basket of companies you can buy in a single click. One of the simplest examples is the Vanguard Total World Stock ETF. VT holds thousands of companies worldwide. When the global economy grows, VT grows. Instead of betting on one company, you own a small piece of the entire world economy. If you can handle more volatility and want higher growth potential, you can add Invesco QQQ Trust. QQQ is an ETF that holds the largest tech companies. It moves more aggressively, both up and down. So when is the best time to buy ETFs? Statistically, as early as possible. History shows there's only a 15% probability the market will be lower in 5 years from now. That means there's an 85% chance it will be higher. So trying to time the market by waiting for a crash is usually the wrong strategy. Over 90% of hedge funds, professionals whose job it is to time the market, fail to beat broad market ETFs like VT over a 10-year period. The longer your time horizon, the higher the probability of positive returns becomes. Yes, markets can drop 30 to 40% in a bad year. That's normal. If that happens, don't panic sell, stay disciplined and keep buying. You only lock in losses when you sell. If you hold or even buy more, history shows long-term growth. Timing the market beats timing the market. Now, the most important part, psychology. This is where most investors fail. They buy high during rallies and panic sell during crashes. The market constantly cycles through collective emotions of fear and greed. To navigate this, you need a plan. Decide in advance why and what you're buying. This is your thesis and portfolio composition. For example, maybe you bet on economic and tech growth with a 50-50 VT and QQQ split. Then you decide how you're buying and the dollar amount. Maybe you buy all at once, lump sum, or gradually over time, DCA, dollar cost averaging. Then you decide when you plan to sell. Most importantly, commit to holding at least 10 years. You won't see massive gains overnight. Wealth building takes time. Your portfolio must match your risk profile. Before you invest, you have to ask yourself, how much of a drop can I handle without panic selling? I group portfolios into 3 risk levels based on historical drawdowns. Low risk, stick with 100% VT. You're betting on the global economy, but you must still expect a potential 40% drop during a major crash. Medium risk. If you want more growth, you add QQQ. This tilts your portfolio towards tech, but it increases the expected drawdown to roughly 60%. And then we have high risk. This adds high conviction tilts towards individual stocks, narrow sector ETFs like the VanEck Semiconductor ETF, or digital assets like BTC. These can massively outperform in bull markets, but there are high conviction plays where 80% drawdowns need to be expected. For most people, a low to medium approach is ideal. Check out our top 10 ETFs grouped by risk level. Build a portfolio that matches your risk tolerance and conviction. High-risk assets require serious due diligence. Always do your own research. A simple rule of thumb, keep at least 35% of your portfolio in low-risk, broad market exposure like VT, and never let speculative, high-risk investments exceed 30% of your total wealth. This way, even if your high conviction plays take a hit, your foundation stays intact. Diversification reduces the risk of extreme losses, and ETFs give you that instantly. You don't need too many ETFs. Usually more than 4 just creates overlap. Most of the time, simple portfolios outperform complicated ones. So, how to actually buy ETFs? To start, you need to open a brokerage account. In the US, Fidelity is great for beginners. My personal top choice is Interactive Brokers. Very powerful platform with global access. There are many other good brokers, but always do your research. Check if your country offers tax-advantaged accounts like a Roth IRA. Once set up, it's simple. Search for the ticker, in our example VT. Click Buy, choose number of shares, select market order, confirm. It's that easy. You now own a small piece of the global economy. By now, you have everything you need to start your investing journey. But on this last slide, I want to show you the real secret to building wealth. It isn't about timing the market or picking the perfect stock. It's about compounding. This is where your money earns returns, and then those returns start earning returns themselves. Compounding starts to really pick up after the first decade. If you invest $1,000 today in a 50-50 VT QQQ portfolio and leave it for 30 years, in a bearish case, assuming 8% yearly returns, your $1,000 grows to roughly $10,000. In a base case with 10% returns, it grows to $17,000. In a bullish case with 12% returns, it grows to around $30,000. Think about that. With just 2 ETFs and 30 years of patience, you could 10 to 30x your initial investment. Cash loses value, productive assets rise. Start early, stay consistent, and let time do the heavy lifting. If you found this guide helpful, subscribe for more simple investing strategies. And don't forget to download the free cheat sheet in the description. It explains exactly how the stock market works in just 2 pages.